Hello, and thank you so much for joining us today. Welcome. I'm very excited for this afternoon's webinar. It's going to be 30 minutes long. If you have any questions throughout, please send it into the chat box, and we'll make sure we try and answer all of your questions. So today we're going to be talking about the mortgage market landscape update, and we have Matthew O'Neill from Connolly Capital with us. Connolly Capital is a company and mortgage brokerage firm. It's a boutique firm, so like ours, independent and boutique. And they have 6 full-time employees. They're located in Port Credit area of Mississauga. And so like myself, Matthew partnered with his father, John, and they started this company 3 years ago. They have achieved rapid success, including several awards for volume contributions to their lending partners. Matt and his team, again, like Watson Investments, bring a highly attentive personal service to their client base and service all across the Greater Toronto region. So thank you so much, Matt, for joining us today. Really excited to hear all of your insights.
Yeah, thanks for the introduction, Jennifer. I really appreciate it. Thanks for having me as well.
So before we start off into the presentation, I just wanted to make a note that if anybody has any follow-up questions from this topic or would like to just have a free consultation with either myself to talk about holistic wealth management or how tax planning can affect your mortgage and how investing and mortgages kind of align, or if you'd like to speak with Matt, both of us are really happy to have those conversations. So please send us an email, reach out, and we're happy to chat.
Perfect. Yeah, so just a brief agenda on what I'm going to be going into. So I'll give a quick introduction. I'll talk about some of what COVID's done to the real estate market and the mortgage market as well. I'll go into interest rates because that's always a hot topic of conversation these days. As well as we'll discuss some borrowing strategies that clients are using during COVID with these ultra low rates, and I'll touch on a net worth program as well through Scotiabank. So who am I and who we are? So Connolly Capital is a mortgage brokerage and a mortgage administration company. So the brokerage side of our business, we deal with 25 lenders, including some of the big 5 banks. And on the mortgage administration side, we deal with private lending and private equity. So basically any client who doesn't fit the bank model, we can help service them with private equity. Okay. We're located in Port Credit, as Jen mentioned. We're at One here, Ontario, so right on the corner of Highway 10 and Lakeshore. 30 years of combined experience, and we usually sit in the top 40 for mortgage brokers across the country. So next, I'm going to touch on some of the impacts that COVID's done to the real estate market. So we noticed a big shift when resale activity occurred. So usually the peak home buying months are into the spring and into the summer months. So usually July and August are the busiest funding months of the year. That has to do with people buying in the spring. This trend was about 4 to 5 months later. This year. So most people purchased in the summer, and November was actually our busiest funding month of the year. Okay? So everything just pushed later in the season. Rental markets are cooling, specifically in the major cities. So Toronto, Vancouver, Montreal, rents are dropping. Some areas in downtown Toronto, rents are down about 30%. Couple reasons why here. So online study has taken over the university areas of especially downtown Ryerson and U of C. Lack of travel and border closure as well has caused less demand for condos, and short-term rental options are basically non-existent. So Airbnbs have shut down completely. Okay. Condo markets, specifically in the condos under 500 square feet, there's a big influx of demand. So anything under 500 square feet right now have noticed price declines and price flattening. Buyer's market has hit. Basically, anytime you have months of inventory over 4, it turns into a buyer's market, and these type of condos are somewhere between 6 and 8 months of inventory right now. Okay. Listings for these specific types of condos are up 165% a year. Okay. Another trend we've noticed is basically outside of Toronto proper and GTA proper, the prices are taking off. So big emerging markets being Collingwood, Woodstock, Ingersoll, these are up anywhere between 25 and 30% year over year. Barrie, Simcoe, so lots of cottage country, basically anywhere outside of Toronto proper has really done well. Oakville, Mississauga, Milton, core GTA, we still notice a lot of price increases, but not quite like outside of the main areas of the GTA. Okay. This has to do with a lot of the falling immigration numbers. So less migrants coming into the major cities. So we're down from 150,000 to under 10,000 net new migrants into Canada. So this has caused basically people fleeing the downtown areas and moving into the suburbs.
And so Matt, those are all really great insights. Thank you. And so I guess what you're seeing then really is that if people now are trying to sell these downtown condos, it's really not the time to sell. So anytime with real estate, I think when you're using it as an investment piece, it's all about managing the how much capital you have to fund it so that you are not forced to sell when it's not a good time to sell. So a lot of those places are losing their tenants if they are for rental purposes. And so the owners are having to carry now these costs or cut the rents. And, that's just the nature, I think, of right now what's happening. So if you are thinking about renting out properties and buying for the purposes of investing, just make sure you always have kind of access to capital or capital available to withstand those times. So you're not forced to sell if it's an investment piece when it's going to be at a loss.
For sure. And new condo listings in downtown are up almost 200% year over year. So if you can hold on to the asset, once the net new migration numbers start coming back, most new immigrants move into condos when they arrive to Canada. So, as to your point, if you can hold the asset, maybe take a couple months loss, I think you'll do well in the long run, for sure.
Great.
So there's a bit of silver lining to all of these trends. So the main thing is the lower cost of borrowing. Okay, so last year around this time, so fall and into winter of 2019, rates were in the low threes. So if you look at your monthly payment per 100,000, you were over $400. That has dropped significantly with rates being under 2%. So people are able to purchase homes that have increased in price with lower monthly mortgage payments just because the cost of funds have gone down. Okay. Another main concern was the number of mortgage payment deferrals. So not only on leases, loans, and cars, but on the mortgages themselves. So at peak COVID, this number was as high as 16%. So 16% of all mortgages in Canada were deferred. Almost 800,000 individual mortgage clients, and this is basically down to zero now. The banks are only allowed for 6 months of deferrals, and that window has now closed. They are making exceptions for certain financial hardship, but the majority of people have started making their payments again, which is obviously good news. Okay. The last thing that happened was CMHC, Canada Mortgage Housing Corporation, they predicted somewhere between a 9 and an 18% drop in prices, and literally the exact opposite happened. As I showed you on the last slide with price increases, we're seeing anywhere between 10 and 30% price increases year over year in the GTA and surrounding areas. Okay. So I'm going to touch on interest rates next. Lots of things have happened, lots of drastic changes to the interest rate market, both on fixed and variable, and I'll get into both. So the biggest changes was the fixed rates. Those are down anywhere between 1 and 1.5% in less than 12 months, similarly to the Bank of Canada's prime rate. So Bank of Canada slashed their prime rate from just under 4% all the way down to 2.45, where it's currently sitting now. So now we're in a situation where both fixed and variable rates are under 2%. So basically everything we're seeing right now has a 1 in front of it, okay? The reason all of this happened is the Bank of Canada cut rates to make lending cheaper. So they wanted to encourage people to borrow, encourage people to spend, encourage people to buy houses, and it seems to have worked, as you saw from the price increases. Okay?
And so, Matt, what do you
Yeah.
typically recommend clients pick? Is it fixed, variable? What have you been recommending in the past, and what are you seeing right now?
Yeah. I've always been a variable person myself. I do like 5-year variable mortgages for a couple reasons. The first is they are convertible. So if you take a variable now at any point in time during the 5-year term, you can always lock it into a fixed rate term. So it's just a more flexible product. We had people take 5-year fixed mortgages last year. They were in the mid 3s, and now look what's happened to the rates. If you had taken a 5-year variable last year, you can lock in right now to a 5-year fixed as an example, and be below 2%. So I like to recommend variable just because I do like the added flexibility of that product. I'll touch on I'll show you kind of an infographic on the fixed rate. So basically this infographic started right before COVID. So this would have been early February. Rates were high 2s into the low 3s. Once COVID hit, so middle of March, you can see this sharp peak in the fixed rate terms. The reason this happened is there was a big concern over the cost of funds. So banks were unsure what the government incentives were going to do. So they started raising rates just as a safety net. And then there's been a sharp decline. So basically every month we're seeing anywhere between 10 and 20 basis points drop on the interest rates. So our 3.24% is all the way down into the high to middle 1s, depending on if you're an insured mortgage or a conventional mortgage. I also put the 5-year bond yield here because this is basically how fixed rates are determined. So the higher the bond yield, the higher the fixed rates are going to be, as the cost of funds are more expensive. I'll go into variable rates next. So very similar to what's happened on the fixed side with the variable side. So the variable rates are based on Bank of Canada's prime rate. So this was dropped from 3.95 all the way down to 2.45. So that middle line represents where prime sits currently today. You've noticed it's been pretty flat since the rate cuts, because really there's not much more to cut on the variable side of things. The banks really don't want to be getting into negative interest rates. And the discounts off of that prime rate are anywhere between 0.75 and 1 right now. As I'm sure a lot of people saw over the past couple of days, HSBC has came out with an offer for under 1%. So the variable rates are being heavily discounted right now to encourage people to borrow and purchase at the end of the year.
I'm glad you touched on that, because that is a very hot topic, hot question right now in terms of why these rates are so low. And, is that a new norm? I know you were telling us a little bit about it over our prep for this webinar, but I think it was very interesting if you can share a little bit more with the audience.
Yeah, so HSBC, I think they had a little bit of a down year. The reason being is this promo for 0.99 is only available for 3 weeks. So it's basically only available from new applications submitted between Monday, which was yesterday, and January 1st. But keep in mind, there's a big lull over the Christmas season in real estate. So really, there's not a lot of transactions happening at the end of December. So basically, this offer is really only available for 3 weeks. It is pretty restrictive. You have to be a first-time home buyer, and your purchase price has to be insured, which means it would be under $1 million with less than 20% down. Okay, so there are a lot of restrictions in order to get this rate. So a very, very limited number of people will qualify, but it did its job with putting it on the front page of major newspapers. So it was more of an advertising ploy, in my opinion, than actually offering a lot of clients this rate under 1%. So what's going to happen next? Central Bank of Canada has stopped purchasing Canada mortgage bonds, which should usher in some stability, keep the mortgage rates flat. We keep saying, you know, rates can't go any lower, and they do, right? So I would say there has to be a rock bottom to all of this. Are we seeing it right now? I would say probably. You know, a rate of 0.99% is just unheard of, even if you're borrowing fixed in mid ones, you know, 1.54%. I think this stability for these low rates are here to stay. The Bank of Canada has been very clear that they're not going to raise the prime rate for at least a few years. Their projection is the end of 2020. So you can see rates with high ones and low twos for the foreseeable future. I would say anywhere between now and until the end of 2022.
Wow. So seeing these really incredible low rates, it really opens up a lot of options, I think, for people's personal planning, because, you know, no longer, I think, are the days that it makes sense to necessarily pay down your mortgage as fast as possible versus investing in the equity market. I think like what we've seen is, you know, typically people have a preference, especially when it comes to the principal residence, in terms of, you know, how much leverage you're comfortable having, so how much debt you're okay with having. What's, you know, that risk tolerance, what's the security in your jobs, your partner's job. But sometimes there is an argument to be made to, you know, have a mortgage and intentionally not pay it down maybe as fast as you could if you want to invest into the equity market. So these are conversations, I mean, we have with our clients all the time. It's something that we put on the financial planning priorities sheet, which is, you know, it's this document we use for all of our clients to keep them financially organized. And one of the sections is debt management. And it's talking about, you know, your primary home, maybe you have a rental property, maybe you have a cottage, and just what's the best way to structure those mortgages, what's the best pay down strategy moving forward, especially with, these very low rates that we're seeing.
Yeah, absolutely. And that's a good segue into kind of the next segment, which would be borrowing strategies. So the first major shift we've seen is larger mortgages. So people are borrowing more. You know, these kind of jumbo mortgages, as you would call them, are you know, it's just kind of the new norm. So, you know, clients having an $800,000 mortgage is totally reasonable. So costs of funds right now are at an all-time low, but the house prices continue to climb. So, you know, clients who maybe are looking to buy and sell, you know, normally if they walk away with proceeds of sale of around $500,000, let's say, in the past, they would put the entirety of the sale back into the new home. We're just not seeing that right now. So clients are holding back cash, taking more from the bank, leveraging basically the bank's money, and then taking their money that they would have put into the deal and investing it in the open market. Just for perspective, so at our office, you know, historically speaking, our average mortgage size would go up anywhere between $10,000 to $25,000 per year. And I crunched the numbers for 2020 versus 2019, and it's almost touching $600,000 now. So that's the average mortgage that we're seeing, and it's over $100,000 increase since 2019, which is pretty substantial. Keep in mind, most of our clients are south of the QEW, I would say between Toronto and Burlington. So most of the homes we see are freehold, you know, detached, semis, and townhomes. Okay. The second borrowing strategy that we're seeing is home equity lines of credit, so also known as a HELOC, and leveraging capital. So with the prime rate being where it is, sitting so low at under 2.5%, clients are refinancing, taking out a home equity line of credit. We can often get these rates at prime, like prime or prime plus 0, all the way to prime plus 0.5. So as opposed to taking a 5-year fixed mortgage and locking in, you can leave your equity floating for future use, and you're still borrowing under 3%. So we're basically borrowing to invest. So leverage the bank's money, strengthen your investment portfolio, TFSAs, RSPs, buying another property such as a rental, or we've seen a lot of people refinance to purchase a cottage, as you saw from the cottage values skyrocketing in Muskoka, and the Kawartha Lakes as well.
Mm-hmm. So having access to capital, that was one of the topics you and I discussed in, again, the preparation of this webinar.
Yep.
And we definitely strongly encourage having access to a home line of credit. It doesn't mean you need to use that line of credit, but having
Mhm.
access to that capital, I think, really just provides that flexibility for the future. Um,
Yep.
and like Matt told us before, that it's smart to do it while you're also still working. It gets a little bit
Yep.
tougher either as you need the money or as your cash flow becomes a little bit less, maybe in retirement.
Yeah, and we always tell clients it's unfortunate. So when you don't need money, the banks are very willing to give it to you. You know, if you walk into a branch, they'll want to pre-approve you for a credit line increase, give you new Visa cards. Like when you don't need it, they tend to offer it up. But as soon as your financial situation changes, maybe you've dealt with hardship, you've lost your job, you're retired, it's just harder to access that credit. So we usually tell clients, you know, if you can take advantage of it now, you know, we'll set it up for you. If you don't use it, you don't pay any interest costs per month. You can just leave it floating at a $0 balance, but it's at least it's there in case of an emergency.
Mm-hmm.
Another strategy we're seeing would be leveraging existing rental portfolios. So a lot of times clients will have a larger mortgage on their owner-occupied residence or their cottage, and maybe they'll have a rental property with a small mortgage, or maybe no mortgage at all. Okay, so because the rates are so low, part of our strategy is, why don't we put the mortgage on the income property? The expenses that go along with that are now tax deductible, including the interest portion of your mortgage payment, and then use that money to pay down what you would borrow on your owner occupied, because those funds, that mortgage fund, is not tax deductible. So it does become good tax and borrowing strategies now that the rates are so low.
Mm-hmm. And so what we've often seen from the financial planning perspective on this is we find that our clients will come to us and, they've bought their first home, then a few years later they buy the cottage, then maybe many years later they've bought that rental property. So
Yeah.
it's done in piecework, basically. So now all of a sudden you're looking at this, and we've put it out in an organized fashion to kind of really highlight it and address the fact that the mortgages haven't been optimized. So then that's a really good time, I think, to, have that reassessment, maybe speak to Matt or any mortgage broker and just see if you can better optimize it. Also, your financial advisor can kind of at least highlight a little bit that, especially around the tax side of things.
Absolutely.
And then see if you can maybe make some changes, even if you're locked in, see if maybe making changes is actually still the financially savvy choice.
Correct. Yep. And the last borrowing strategy we're seeing kind of relates to the last one with the low rates, is seeing if it's advantageous to, kind of do a mortgage review or a mortgage plan. So, over the last 2 years, if you locked in at a 5-year fixed mortgage, you probably have a 3 in front of your rate. Or if it's got a 2 in front of it, it's maybe 279 or 299. So we're often doing calculations to see, okay, if we break this mortgage and we basically start new at a new lender at a lower rate, is it advantageous to you, or are you going to save money? So we would do the calculation based on your current penalty versus the interest saved over the next 5 years that you're relocking in at a lower rate. The final thing I wanted to touch on is a net worth program we have available to us. There was, yeah.
So this is before you dive into it, it's a really, really interesting program. And actually, for one of our clients, they were discussing mortgage options, and I had called up Matt to ask some questions on their behalf. And he mentioned this net worth program to me, which just made a lot of sense. I think for people in certain phases of their life, and also for business owners, it can really work well. So I'm excited for Matt to explain it more to us.
Yeah, for sure. So there was a big hole in the market on the mortgage broker channel and even with the banks. So basically, any individual on a fixed income, they weren't able to qualify for a mortgage, even if they had a large asset pool. So a lot of the times we'll see, clients retired, maybe they sold their business, they have a few $1 million in assets or investments, but they're not generating any income outside of their investment portfolio. Okay? So what we've been able to do through Scotiabank is it's basically a hybrid lending program between net worth and assets and income. Okay, so as long as the investment portfolio has $250,000 or more, they will lend dollar for dollar, basically. So if you have a $500,000 TFSA portfolio, as an example, you're able to borrow up to a $500,000 mortgage. Okay, so it basically eliminates the, kind of that segment where, retired, maybe they're only on CPP and OAS, but they would like to borrow and take advantage of these low rates without actually depleting their investment portfolio to purchase the home. Okay. It's available on all types of housing starts, so primary, secondary, and rental properties. So we've noticed it a lot on rental properties, which has been really great. So, clients trying to diversify their portfolio and purchase a rental property. The main thing we really like about this program is you do not have to liquidate your portfolio and switch it to Scotiabank. Okay, so they're not, this isn't kind of a segue for clients to, deplete their funds, switch it in with one of their advisors. You're welcome to leave everything exactly where it is. We just provide statements to the underwriting team that you actually do own the assets and the portfolio, and a lot of times we're able to borrow up to 80% of the home's value. So if you're looking for a home equity line of credit, through a refinance or even set this up through a purchase, it's all eligible through the total net worth program.
That's great.
Yeah.
Well, thank you so much, Matt, for this presentation. It was really, really interesting.
No problem.
We're almost at 12:30. We have a few more questions. So if you are available to stay on for a few questions, that would be great. And please feel free to reach out to Matt or myself to discuss your mortgage strategy, your tax planning strategy. For Matt, anything to do with lending. For myself, anything to do with holistic wealth management or investment strategies. We're happy to have a conversation. In the chat box, you're going to see a link actually to a Calendly, which will allow you to automatically book a virtual consultation with me. And please email Matthew at connollycapital.ca. All right, so to dive into our questions right now. Yep. The first one we have for you is, so specifically for business owners, can you talk a little bit more about their ability to get mortgages? And the reason I kind of target them is because perhaps, their T4 income is a little bit lower because they've been able to do some tax planning and keep more money in the operating company or perhaps in a holding company. And so how does that kind of affect their abilities then to get mortgages? And you mentioned the most recent strategy is an option. Mm-hmm. What other options do you have? What's kind of the go-to recommendation for those for business owners?
Yeah, so of our brokering portfolio, 3 of every 10 clients that we deal with do not qualify at the bank. And the main reason of that segment is they're self-employed. So to your point, the business does really well. They have really strong gross revenue, but they keep all of the money in the corporation and they pay themselves, a smaller salary for tax purposes. So a lot of those deals go to our alternate lending channel, also known as B lending. So basically they will use the gross income from the business versus the net income from the person who owns the business. So they're not concerned about the T4s. They're not looking at your personal tax returns. They're really concerned with, does the business that this client owns have the capacity to make money?
That's great. Thank you so much.
Yep.
And when do you have business owners that buy companies in the holding company versus in their personal name? And when is kind of using a holding company to purchase properties kind of a smart decision?
Yeah, so I've seen this done multiple different ways. The common denominator, I think, is the number of properties. So when you're purchasing properties in holding corporations, there are added end of year costs, right? So you will have to do a separate income tax filing for the corporation who owns the property. So there are added expenses on an annual basis. Generally speaking, when we see multiple rental properties, this is when it's a very advantageous strategy. So basically building wealth through real estate. You know, if you just have maybe an owner occupied and then maybe one small rental property, the purchasing in a holdco might not be advantageous by the time you line up some of the other added expenses with using that strategy.
That's great. Okay, well, thank you so much, Matt. That's all the questions we have for you at this point in time. Really, really appreciate your time. And thank you,
No problem.
everybody, for tuning in today. We hope you found this very valuable, and we hope you will reach out to both of us for follow-up conversations. So thanks so much,
Thanks for having me.
and
I
enjoy
appreciate
the
it.
rest of your day.
Thank you.
Bye.